In 1993, exchange-traded funds or ETFs were introduced to the market. Over the years, they've dominated the fund sector, surpassing mutual funds as the most popular investment option. This is surprising given that mutual funds have been operational for over a century, with the first one being established in 1924. ETFs are distinct from mutual funds in that they may be traded intraday, much like conventional stocks. On the other hand, mutual funds may only be exchanged at a set price after each trading day. ETFs are a popular option for retirement funds as well, as compared to alternatives. ETFs have lower cost ratios, provide intraday trading, and have lesser tax exposure. However, you may be wondering which ETFs are worthwhile. If so, stay tuned and pay attention. Hello and welcome to this intriguing video we have tailored just for you. Today we'll talk about an investment option you might consider, the ETFs that you should buy now. So before looking at the top 10 ETFs, make sure to subscribe to the channel if you haven't done that already. And leave the notification bell on, and having done that, let's get fired up and start. Number 10. Schwab U.S. TIPS ETF. TIPS, Treasury Inflation Protected Securities, are meant to safeguard investors against inflation. Tierney notes that although investors are less aware of the TIPS category, SCHP is a pretty basic approach to obtain access to the market. This ETF, according to Tierney, is the most comprehensive depiction of the whole TIPS market that can be acquired with a single unit of stock. Morningstar has given SCHP a gold analyst rating, which is the firm's highest. Morningstar's analyst rating of gold, silver, bronze, neutral, and negative indicate how well a company will do in the future. SCHP also has a Morningstar rating of 4 out of 5 stars, which shows how well the ETF has performed in the past. SCHP has a 0.05% cost ratio, which means that for every $10,000 invested, you'll only pay $5 in yearly management fees. Number 9. Vanguard Total International Stock ETF, VXUS. According to Rich Powers, head of ETFs and index product management at Vanguard, Vanguard's ETFs are characterized by delivering low-cost options that closely mirror their benchmarks. VXUS is a passively managed foreign fund that follows the FTSE Global All-Cap ex-US Index. This market capitalization weighted index aims to replicate the performance of firms in established and developing economies outside of the United States. This method allows investors to diversify their portfolio by including overseas exposure. Morningstar has given the fund a gold rating and 3 stars since its inception in January 2011. VXUS has a 0.08% expenditure ratio. Number 8. ProShares S&P 500 Dividend Aristocrats ETF, NOBL. The ProShares S&P 500 Dividend Aristocrats ETF may be perfect if you're worried about the local and global economy stability. NOBL, which is worth noting is a suitable ticker symbol, concentrates on dividend aristocrats or firms that build their reputation on supporting their shareholders, as the brand name indicates. A dividend aristocrat is a company that pays its shareholders on time and has also increased its dividends for at least the previous 25 years. Naturally, because attaining this prestigious position takes at least a quarter-century, organizations in this exclusive group are hesitant to lose it. As a result, NOBL is one of the finest ETFs to purchase for safety. However, like with other things in life, you typically pay a premium for exceptional items or services. Investors in the NOBL ETF will pay an expense ratio of 0.35%, which isn't all that different from the category average of 0.39%. On the bright side, NOBL is up 16.3% year to date, indicating that other investors think it's currently one of the best ETFs. Number 7. iShares ESG Aware MSCI EM ETF, ESGE. We are inundated with news and opinions about how younger folks are concerned about the environment and other concerns of sustainability and responsibility. The Pew Research Center, for example, validated millennials and Generation Z's concentration on awareness. Does this, however, transfer to the investment market? Data from MagnifyMoney.com suggests that young social and environmental activists put their money where their mouth is, surprising some. Nearly 3/4 of Gen Z investors, 73% to be exact, have resisted dumping money into firms for moral or ethical grounds, compared to 56% of millennials, 48% of Gen Xers, and 39% of baby boomers, according to Magnify Money poll. Whether you agree or disagree, you must follow the crowd. Investors may wish to investigate the iShares ESG-aware MSCI EM ETF as environmental, social, and governance issues become more important. You may earn from ESG and feel good about it by focusing on firms that promote positive change across the three sectors of the ESG movement. If that wasn't enough, ESGE offers a low expense ratio of 0.25%, far below the category average of 0.48%. Number 6. Energy Select Sector SPDR Fund, ticker XLE. Woodard's top diversified energy sector ETF recommendation is the Energy Select Sector SPDR Fund, which follows an index of S&P 500 energy sector companies. According to Woodard of the energy ETFs Woodard examines, the XLE fund has the greatest optimistic price momentum and the strongest 3-year Sortino ratio. Sortino ratios are a risk-adjusted performance indicator for mutual funds. ExxonMobil Corp. or XOM, Chevron Corp., CVX, and EOG Resources Inc. are among the fund's top positions in the energy sector. The XLE fund has a 0.1% cost ratio and pays a 3.4% dividend, more than twice the S&P 500 average. The XLE ETF gets a more favorable rating from Bank of America. If you're looking for an investment, you should consider it. Number 5. iShares U.S. Oil and Gas Exploration and Production ETF, IEO. Woodard recommends the iShares U.S. Oil and Gas Exploration and Production ETF among U.S. oil exploration and production funds. Bank of America analysts rate around 68% of the IEO fund's stock holding as buy. Oil exploration and production businesses, according to Woodard, have turned their attention to capital returns to shareholders and are more conscious than in the past of the long-term ramifications of excessive development. ConocoPhillips, COP, EOG Resources, and Pioneer Natural Resources Co. are among the top holdings in the IEO fund PXD. The IEO ETF, which has a 0.42% cost ratio, gets a more favorable rating from Bank of America. Number 4. Invesco DB Commodity Index Tracking Fund, ticker DBC. This Invesco ETF provides a buffer against increasing costs and a straightforward approach for investors to profit from this trend in an inflationary climate. This fund holds a selection of the world's most popular commodities such as crude oil, metals like aluminum, and crops like maize. And unlike a normal stock-based fund that invests in producers, DBC is directly connected to future contracts, allowing you to get exposure to real commodity price movement rather than just commodities-related equities. This is a go-to approach to play raw materials with over $4 billion in assets. With more than 30% gains in 2022, despite a down market, this ETF is very appealing. Number 3. Avantis U.S. Small Cap Value ETF, NYSE AVUV. The Avantis U.S. Small Cap Value ETF invests in small cap value equities across market sectors and industries. Futures, contracts, currency, forwards, and swap agreements are examples of derivative products that the fund may invest in. Alcoa Corporation, on NYSE, that's AA, is a firm that manufactures and distributes aluminum products, and the Avantis U.S. Small Cap Value ETF has a big holding in it. In the fourth quarter of 2021, 41 hedge funds in Insider Monkey's database owned holdings in Alcoa Corporation, worth $1.4 billion, compared to 44 in the previous quarter, worth $1.7 billion. Due to this, the EFT qualifies for the list that we have compiled for you today. Number 2. ProShares K1 Free Crude Oil Strategy ETF, OILK. In 2022, many investors are turning to MLPs, or Master Limited Partnerships. In general, this particular class of equities comprises energy infrastructure bets with upside potential and high payouts due to the present inflationary climate. The hitch is that MLP's partnership structure necessitates some time-consuming paperwork, including a complicated K1 tax form that perplexes many investors and even some CPAs. This ProShares fund eliminates that barrier by providing diversified exposure to oil-related partnerships in a way that doesn't need you to fill out the dreaded K1 form every year. It's a compelling product for this reason alone. But the 40% returns so far in 2022 make it much more tempting. Number 1. Vanguard Real Estate ETF, VNQ. VNQ, another Morningstar Gold-related fund with an expense ratio of 0.12% compared to an average cost of 1.08% for comparable products. This passively managed fund follows the MSCI U.S. Investable Market Real Estate 25 by 50 Index. VNQ invests monthly in equities issued by real estate investment trusts to mirror the index. Since its debut in 2004, VNQ has generated an average annual return of 9.79%, while its benchmark index has returned 9.81% during the same period. VNQ's market cap weighted portfolio and ultra low cost should make it tough to beat over the long run, according to analyst Jackson. That will be all for today's video. All of these ETFs are worth the risk. Which one are you going to try? Also, did you enjoy the video? Please share with us in the comment section about these and suggest what you'd like to watch related to finance. Don't forget to subscribe to the channel and turn on the post notification bell. Until the next one, be safe. Bye-bye.